Subscribing to this channel provides you regular access to professional advice on independent operators. If you want to support us, like, share, and turn on that notification.
Welcome to Making Your Miles Count Production, an educational program to all Canadian lease owner-operators with your host, Robert Scaper.
To lease or not to lease? That is the question. This video is designed to give you the answers you need to make the best choice for your business. Some people just want to know the bottom line answer. Others want to know the details and logic used to come to that conclusion. In this video, the longer you listen, the more details you will get on this topic. I guess once you've got enough information, you can just stop listening. So, should you lease or should you own? If at all possible, own. There are two primary reasons for this: control and interest charges. In a lease situation, you do not own the vehicle. The leasing company does. So if you get into an accident and it's written off, the owner, not you, is contacted by the insurance company. The negotiations for the payout value can be made completely without your input, even though you are left with the conclusion of their negotiations. Your opinion of value may be irrelevant. Now, the amount of inclusion you will have in the conversation will depend almost entirely on what carrier you drive for. When it comes to settling independent operators' claims, some carriers are not that motivated. They become very defensive and won't even allow operators to participate. Some carrier contracts explicitly state the carrier has legal rights to negotiate a final settlement on your behalf. However, most carriers will not usually sign off on a claim unless you sign as well. That being said, it is still very important to find out your particular carrier's claim history and policy. What effect does their self-insuring have on claim settlements? So, if you're going to lease a vehicle for 5 or 6 years, you should ask yourself, will I be at the same carrier for the entire time of this lease? Hopefully. But it is something to consider when or if you think about switching carriers. Whether you own or lease, everyone knows interest is calculated. You'll be told the interest rate in both circumstances. Whenever you make a loan payment, part of it goes towards interest and part to pay down the principal. Then, when you make your next payment, your interest charged is less because your debt is now smaller. When you make a lease payment, that's not always what happens. At the time of signing your lease, payment amount is calculated for your entire term, 4, 5, 6 years. Then, when you make a payment, it is recorded as one less payment. There is no principal or interest calculations. So, what happens when you get into an accident? Or if you decide to trade it in halfway through your lease? They just total up all your future lease payments, which obviously include interests, and ask you for payment in full. Approximately 30% of all leases never reach the end of the term, due to either accidents or trade-in. This means that those leases, when they are closed, paid interest right to the end of the term, even though the term was cut short. This increases the total cost of your truck. If you make your lease payments right to the end of the term, you dodged a bullet. However, if at the time of purchase you decided to own the truck, you wouldn't have been exposed to the bullet in the first place. Therefore, if you can, own. Many years ago, I had a client who leased a new truck. He thought there was no difference between owning or leasing. He put $30,000 down, paid $3,000 per month for 6 months, and then got into an accident, writing it off. In his case, he could not negotiate with the insurance company. After the parties settled on a value, he was notified by mail that he owed an additional $10,000. So, after 6 months of use, his total rent was $58,000 or $9,600 per month. That is super high rent. Leasing companies can offer various insurance plans that will protect you from these type of events. They have various names: top-up, gap insurance, down payment insurance, or other creative names. I call them, "We screwed you so bad on this lease that we need you to buy more insurance," insurance. This is not normal business insurance. This is financial underwater insurance. If you can, own. Not all leases charge interest to the end of the term on early cancellation. However, you almost always have to specifically ask for an exemption. This responsibility is yours. If you can avoid this bullet. In leases, the devil is in the details, if you define the devil as hidden costs. The good news is more and more operators are understanding the costs and are refusing them. But operators still have to show the financing guys they know about this bullet. Oftentimes, those in charge of arranging financing imply the terms of leasing are more beneficial than the terms of owning. If so, you now know the real cost of those beneficial terms. Every contract is a negotiation. It's not written in stone. The one who can say no first, and mean it, is the one who has most of the power. If you can walk away, you have control over the terms, to a point. Why should the financing company negotiate when they know that the purchaser has no other choice? This is why operators should usually begin the equipment upgrade cycle by arranging financing first. If you don't like the terms, walk away. If they change the terms right at the last minute, walk away. In business, never put yourself in a position you can't or won't walk away. So, what tax difference is there between owning and leasing, assuming the interest rates are identical? If you lease a truck without that bullet clause, nothing. There is no tax savings. If someone tells you there is, they either don't know what they're talking about or they're trying to sell you something. They're getting something out of it. Maybe a kickback, commission, bonus, bragging rights, something. There is no tax savings. There is a possible tax deferral into next year, and that only if the circumstances line up. However, later, that advantage will be exactly reversed, till eventually you get down to zero difference. Let me explain. When you lease a truck, 100% of your payments are expensed until your final payment, when you buy it or trade it in. Even if it's only $100, you will eventually own it. Then, when you sell it, you will have to pay taxes on the recapture, the difference between what you bought it for, $100, and what you sold it for. When you own a truck, you expense both interest and depreciation every year until you finally sell it. Then, you will have to pay taxes on the recapture, the difference between what you've depreciated it down to and what you sold it for. The difference? Nothing. You pay the exact amount of taxes either way. When someone disagrees, they may be referring to a snapshot in time, say 1 year's picture, not the whole term of the equipment or your career as an operator. As a professional business person, you must view the big picture, not just the short-term, temporary effects. Major business decisions require a clear understanding of the big picture. You must understand the difference between short-term tax deferring and actual tax savings. They are very different. Probably the easiest way to explain actual tax savings is to demonstrate non-taxable benefits. Let's say you work for me and I asked you to use your personal car to run some errands for your job. We agree that the business will reimburse you 48 cents per kilometer. You run the errands and give me a form that shows you traveled 100 kilometers. My business gives you a check for $48. You can deposit it and not have to claim it anywhere on your tax return. It is a non-taxable benefit. Now, you do have some associated costs with using your vehicle: gas, oil, mechanical wear and tears, depreciation, insurance, licensing, etc. In theory, your costs should equal your reimbursement, but it's only an estimate. Whatever the rate the business uses, in this case 48 cents a kilometer, under audit, it must be defended by an accountant. The defense to CRA can be a completely different argument from what you actually experienced. What if you used a Lamborghini or a Hummer? What would your actual cost per kilometer be? Easily, it could be 60, 70, 80 cents per kilometer. That is your choice, your results. What if you used an old yet fuel economic vehicle? Your actual cost could be 25, 35, or 40 cents per kilometer. Again, that's your choice, your results. If your actual costs were 35 cents per kilometer, you would have made $13 in tax-free money, while your employer expensed the entire $48. So, if you owned a corporation and had the exact agreement, your corporation could expense 100% and you deposit the $48 tax-free, personally pay the $35 in car expenses, and keep the $13 tax-free. This is an example of actual tax savings. Most people think tax savings comes from invoices, like rebuilding an engine. Yes, it does reduce taxes, but only because your income dropped by the cost of the in-frame. Using that logic, why don't you cover your truck with chrome? Reduce your driving down to 1,000 miles per month. Overpay on the purchase of your truck, or just ask your bank to charge you 30% interest on your truck loan. Your taxes could be zero, but only because you didn't make any money. That's not saving taxes. That's just reducing income. So, what is your goal in business? Is it to pay as little taxes as possible? Not really. It's actually getting the highest return on your investment. Let me give you an extreme but true example of getting a high return on investment. I know an operator a number of years ago who bought a truck for $100,000, drove it for 2 years, and sold it for $110,000, with virtually no maintenance, by the way. Not only did he have a rent-free truck, he made $10,000 on the sale. Did he pay taxes? You bet. But we can easily see he built after-tax wealth. If everyone could do this, the independent operator industry would be rich. Your goal should be to get the highest return on your investment, not the lowest taxes at all cost. To get that, you can't overpay for a truck, and you must be able to get the best price for its sale, cash or trade-in. And of course, the highest operating profit from the miles traveled. Taxes are somewhat irrelevant. Business professionals treat taxes as an expense, no different than, say, fuel cost, which they try to reduce but know they can't eliminate. It's included in the cost of gaining after-tax wealth. That doesn't mean tax planning isn't necessary. Those who know me know I'm big on tax planning. I wrote a book on it. But the primary objective is not to eliminate taxes at all costs. Nearly every operator asks the same question: should I pay taxes or should I buy, lease another new truck? In upgrading your equipment, you must consider only two things: fuel costs and maintenance. Taxes should never be a consideration in upgrading equipment. Never, never, never. It is irrelevant. There's one super rare situation to consider other than fuel and maintenance. That's when someone offers you an obscene amount of money for your truck and you can replace it at a bargain. The questions to ask are: will you be getting better fuel economy on the new truck? Will your current maintenance be less than the maintenance on your new truck plus payment, depreciation, and interest? These are the real questions. Let's consider the real tax situation. For every $3,000 of income, you will be paying $1,000 in taxes. That means you will get to keep $2,000 as an after-tax return on investment. These are the important numbers for independent operators to consider. Do you send away $3,000 in payments, depreciation, and interest, or send $1,000 to Revenue Canada? Do you appreciate after-tax wealth, or do you absolutely hate taxes, sacrificing your own financial future so you don't have to pay them? This issue is not complicated up here. However, it is complicated in here. Look, we all hate taxes. I don't know a single person who enjoys paying them. But in the end, you have to make the best financial choice for you. There are only 4 issues relating to managing a truck as an independent operator. What is the cost of your truck? What is the fuel consumption? What is the maintenance cost? And what is your truck's sale price or residual value? Your objective is to manage these 4 productively in your after-tax best interest. There is no tax savings on any of these issues. Nearly all the tax savings operators can utilize comes from non-taxable benefits as described in my first book. That produces savings of $10,000 to $12,000 per year per operator, but it has nothing to do with upgrading equipment. So, what does happen when someone buys a new truck? First of all, we should have a clear understanding of what depreciation is. Not everyone does. If you buy a truck for $150,000 after operating it for 5 years, will it still be worth $150,000? Of course not. It may only be worth $50,000. So what happened? It dropped in market value. That depreciation is an expense to your business. So, will it be worth $50,000, $20,000, or $80,000? In other words, how fast will your truck drop in value? Frankly, nobody knows exactly. Each truck may vary. Each year may vary. And it may take years to see the exact amount of depreciation, specifically the day you sell the truck. Let's look at an example. Which operator got a higher value in 5 years? Operator A consumed $100,000, whereas Operator B consumed only $80,000. Operator B is $20,000 ahead of Operator A, not to mention the higher annual costs of interest, insuring, and licensing IRP the higher priced truck. This is how to expose the exact equipment costs from the date of purchase to the date of sale. So, what do you do in the years waiting for the actual figure? When something depreciates in value over a number of years, Canada Revenue Agency regulates estimates of what the value should be at the end of the year. These regulated estimates are different rates based on what you are buying or what class of asset you purchased. For example, a building in Class 6 is depreciated 10% in a year. A highway tractor is either classified as Class 10 or Class 16. Class 10 depreciates 30% in a year, while Class 16 depreciates 40%. Remember, these are just estimates. In the end, this maximum estimate will be balanced against your actual bill of sale. What happens year over year is just temporary. The closer to actual it is, the less effect it will have in the year you sell out. But in the end, the total equipment cost and ultimate taxes paid will always be the same. Canada Revenue Agency's estimates are fairly close. Even so, the rules have a few assumptions. For instance, they assume business owners upgrade their assets, and they design the rules so there will be as few tax interruptions as possible. It's a reasonable design. If CRA's estimate depreciated your truck faster than the market did, you legally expensed too much of your truck, temporarily deferring taxes into the future. Someday, you're going to have to pay those taxes, just not this year. So, what is deferring taxes? Allow me to give you a clear example of deferring. Let's say you leave Toronto with a full tank of fuel and drive until you have 1/8 of a tank. Instead of filling up, you only put in half a tank of fuel. Have you saved fuel costs? No. You've only deferred the cost of fuel into a later time, a future fuel stop. What if you never put in more than half a tank? Are you a phenomenal manager of fuel? No. You've saved nothing. Bumping a cost into the short-term future isn't saving you anything. Deferring taxes into a future time frame saves nothing. If you manage your business only focusing on short-term deferral issues, you are confusing cash flow with what makes and loses you money. Deferring taxes doesn't save you anything. Canada Revenue Agency's rules are designed so that there will be as few tax interruptions as possible. When equipment is upgraded regularly over an extended period of time, the rules can have domino or cumulative effects. Deferrals can be added to deferrals. I'll simplify an example to show you what can happen. This example shows how you can own a new truck while the book value is half the purchase price. Turning over equipment can continue a tax deferral for as long as you own that asset class. An independent operator needs to understand the potential impact of leaving the industry or selling without buying, which may occur switching from owning a truck to leasing one. Your accountant should be consulted before an upgrade like this is considered. If your tax plan is primarily to defer taxes, you will be tempted to trade your truck in as soon as it's depreciated or lease expense is used up. However, trading in your truck automatically exposes you to some form of actual market depreciation, to a point. Let's look at our prior illustration. Trading in your truck will lock in exactly how much that truck cost you over 5 years, $80,000 or $16,000 per year. Holding on to it lowers your cost year over year. The longer you hold on to a truck, the less depreciation costs you will have. Therefore, the higher taxes will be due. The goal is to have high return on your investment. You get the highest return when your consumption or depreciation costs are down. Comparing deferred taxes between leasing and owning is not nearly as clear as some imply. The general impression is that leasing allows you to defer much more than owning. Besides the fact that deferring saves you nothing, I don't agree. I have run dozens of different scenarios and it's usually negligible. If your truck is recorded as a Class 16 asset, you'll be depreciating at 40%, 20% in the first year. If you add the interest charged, it can actually total to higher than your total lease payments. The first year may actually defer more taxes purchasing than leasing. It will depend on the size of your down payment and what time of the year you buy it. Even so, remember, deferring taxes saves you nothing. It's only a shell game. A much more important issue is interest rates. If you consider purchasing a truck through a bank that borrows you funds at 6% or a leasing company that charges you 8% or vice versa, take the lower interest rate. You are saving 2% interest costs, which reduce the total cost of your truck. The only temporary deferring advantage a lease may have over owning would be linked to the buyout figure. If your lease has a $100 buyout after 5 years, chances are the depreciated book value has not gone that low. It may be only $20,000. At first glance, you may think you've successfully deferred taxes on $19,900 or $7,000, but you're only comparing part of the information. You must also include the thousands or maybe tens of thousands of dollars in interest expense, which was recorded separately from depreciation. The temporary deferral difference between loan and lease is usually small, even close to the end of your payment terms. So, what about financing used trucks? Used truck financing is a very different market from new. Manufacturers all have their own financing companies. Just like Ford Motor Company owns and operates Ford Credit, highway tractor manufacturers have their own financing companies. Their highest priority is financing new trucks, not used. Used trucks are much more risky to finance than new ones, or so the theory goes. Many equipment financing companies have surfaced to take up the demand. Some have negotiated with dealerships or even manufacturers as their go-to source for used equipment financing. The added risk has required additional costs, sometimes in percentage rates, sometimes in fees, sometimes in hidden methods I call hyper-retail. I've written a few articles on this topic in Over the Road magazine. Hyper-retail is a leasing situation where a person is led to believe the cost of the vehicle is a certain price, but they are actually financing it for a lot more. Let me use an example of what I've actually witnessed. An operator goes to a dealer and makes an offer on a truck, say $40,000. The salesman agrees and they go in for financing. The agreement is written up as an 11% lease. The bill of sale paperwork is presented as follows: $40,000 plus HST of $5,200 with a total of $45,200. The 11% lease payment schedule is presented as $5,000 down and 36 monthly payments of $1,645 plus HST, ending with a $100 buyout figure. Sounds about right? Probably, until you run the figures through a simple spreadsheet. With $5,000 down and 36 equal $1,645 payments at 11%, you have way overpaid for your $40,000 truck by over $21,000. Run the spreadsheet with a 38% interest rate, then it works out fine. The actual lease payment schedule should have been $5,000 down and 36 monthly payments of $1,145, ending with a $100 buyout figure. So, what happened? The bill of sale you were presented with was between the dealership and the financing company. Firstly, you're not allowed to collect back the $5,200 in HST because you are not the purchaser. The financing company is. The only document that pertains to you is the lease agreement, which may or may not show the interest rate. It usually just shows the payment schedule. Yes, you're allowed to claim back the monthly HST payments, but that's about it. In order to calculate what the cost of the truck is, you have to work backwards from your buyout figure, payments, and 11% interest. It will show your actual purchase price being $55,200 less $5,000 rather than $45,200 less $5,000. I call these hyper retail leases because after the financing company buys the truck, they mark it up before they calculate your lease payments, hence hyper retail. This is just one example of what they can do. There are many other mathematical tricks. Another very popular one that I've seen is simply including the HST in the financing figure. Even though the financing company can claim back the HST, they add it to the financing price. It is true that they have to put out the entire amount, but they usually don't make a lump sum payment for you when they get their HST refunded them. It becomes a part of their income and a part of the cost of the truck to you. So, are you eager to look at your lease and figure out if you've been had so you can sue someone for fraud? Forget about it. There's nothing illegal about what they just did, other than maybe misleading you. The only agreement you signed was the lease agreement. It is your responsibility to calculate the amount you want to pay for the equipment on a lease. Any other agreement you may or may not see is irrelevant to the lease agreement you are responsible to pay. By the way, I don't think I've ever seen a used truck lease agreement that didn't charge interest to the end of the term regardless of early payout. I assume most, if not all, used truck financing has that bullet clause. The good news is you have a way out. Own. It may take longer to secure, it may be more details than you want to deal with, but the return you get through lower costs can sometimes pay you thousands of dollars per hour. As we discussed, the financial goal is to build after-tax wealth, equity, pure, clean, unrestricted ownership as soon as possible. The best way to build equity is to ensure the terms of your agreement are designed to provide you the best opportunity to lower all your costs. The used truck market is very different from new truck financing. The risks are very different and the clientele or customer is different. There are a lot more independent operators in this market who have too small down payment, no additional security available, or even damaged credit ratings. Sometimes the options for ownership is just not there. Regardless, you should understand these types of terms before you talk to a financing guy or salesman. Know your numbers and use your calculator when looking at upgrading equipment. If you don't like what you see, walk away. You operate in a buyer beware market, or should I say leaser beware. Have a great trip.
Thanks for stopping by Making Your Miles Count. For further Making Your Miles Count productions, call us at 877-987-9787 or download us at makingyourmilescount.com.